The biggest trading mistake most traders make is chasing the middle of a move. By the time they finally enter, the trend is already well underway, their stop loss is larger, and the reward is much smaller. But the biggest opportunities don't usually come from chasing trends. They come from recognizing when a trend is about to continue, or when it's about to reverse. That's exactly what I'll show you in this video. We'll cover how trends actually work, how to spot the difference between a real reversal and a fake one, and then we'll combine everything into a simple trading strategy using smart money concepts. Finally, we'll apply everything on live charts so you can see exactly how it works. Let's jump straight into it. The first thing we always need to understand is market structure. Right here, price is making higher highs and higher lows, so we're clearly in an uptrend. Every time price breaks above the previous high, it tells us buyers are still in control. Once that breakout happens, this swing low becomes our new strong low because it's the level buyers are expected to defend if price pulls back. As long as price continues respecting these strong lows, we should only be looking for buying opportunities because we're trading with the trend, not against it. Notice how every new impulse starts from one of these strong lows? That's not a coincidence. It tells us buyers are consistently stepping back into the market before sellers can take control. Now watch what happens here. Price tries to continue higher but fails to create another higher high. That's our first warning sign. A healthy trend should have no problem creating another higher high. The moment it struggles, we know something has changed, even if the reversal hasn't happened yet. Then sellers step in and break below the most recent strong low. This is what traders call a change of character. It's one of the earliest signs that buyers may be losing control, and the market could be preparing for a reversal. But here's where many traders make a costly mistake. They assume every change of character means the trend is over. It doesn't. Sometimes the market creates what looks like a perfect reversal, only to continue moving higher afterward. So before taking any trade, we need to determine whether the change of character is genuine or simply a trap. One common example is when price breaks below the strong low but immediately reverses and starts moving back higher. If sellers were truly in control, they should continue pushing the market lower. Instead, buyers step back in and reclaim the trend. In this case, the change of character becomes invalid. Another situation happens around liquidity. Notice this swing low. Many traders place their stop losses below obvious lows like this. Professional traders are aware of such move. So price may briefly trade below the level, trigger those stop losses, collect the liquidity, and then immediately reverse higher. To inexperienced traders, it looks like a confirmed bearish breakout. In reality, it was simply a liquidity grab before the trend continued. This is why experienced traders don't react to the first break they see. They wait to see how price behaves after the liquidity has been taken. That reaction usually tells the real story. There's one more situation we need to recognize. Sometimes a fair value gap sits below the strong low. Price drops just enough to fill that imbalance before immediately moving back higher. The move wasn't a true reversal. It was simply the market rebalancing itself before continuing in the original direction. By recognizing these false signals, we avoid selling too early and focus only on the highest quality reversals. So what does a real reversal actually look like? It starts with weakness. Price fails to create another higher high. Then sellers break below the strong low with strong momentum. At the same time, notice the momentum changing. Earlier, buyers were creating bullish fair value gaps during every impulse higher. Now sellers enter aggressively and begin creating bearish fair value gaps instead. That's a strong clue that control is shifting from buyers to sellers. The best reversals usually don't happen randomly either. They often occur at important higher time frame supply or demand zones, where institutions are already interested in the market. When location, market structure, and momentum all begin telling the same story, the probability of a successful reversal increases significantly. That's exactly what we're trying to achieve with this strategy. Once we understand this behavior, we can build a complete trading strategy around it. We always begin on the higher time frame. Our goal isn't to find an entry yet. We're simply identifying the market direction and marking important supply or demand zones. If the trend isn't obvious, don't force a trade. Move to another chart. One of the easiest ways to lose money is forcing trades in markets that don't have a clear structure. If you have to convince yourself the trend exists, it's usually better to leave that chart alone. Once we've identified the trend, we mark the candle that created a strong imbalance, or the candle followed by 3 strong momentum candles. These become our supply zone. Now we wait. Patience is one of the biggest parts of this strategy. When price finally enters our higher time frame zone, we switch to a lower time frame for confirmation. The lower time frame gives us the timing. The higher time frame gives us the direction. This combination is what keeps us from blindly buying or selling every supply and demand zone we find. We allow the lower time frame to prove that the market is actually beginning to reverse. Now we're looking for one of two entry models. The first combines a liquidity sweep with a change of character. Price enters our higher time frame supply zone and pushes slightly above the previous high, taking buy-side liquidity. Many traders see this breakout and buy. Instead, the market immediately reverses and breaks below the most recent high or low. Now we have two confirmations. Liquidity has been swept and market structure has shifted. Rather than chasing the move lower, we simply wait for price to retrace into the new bearish fair value gap before entering the short position. The second entry model uses an inversion fair value gap. As price enters the higher time frame zone, buyers initially appear strong. Then sellers suddenly step in with enough momentum to completely shift the market. The bullish imbalance is replaced by a bearish imbalance, creating an inversion fair value gap. This tells us momentum has changed hands. Instead of buying pressure controlling the market, sellers are now in control. We place our entry at the beginning of that zone, keep our stop loss just beyond it, and target at least a 1-to-2 or 1-to-3 risk-to-reward ratio. You can also target the next higher time frame key level. Another technique is trailing your stop loss. As price continues making lower lows during a short trade, simply move your stop loss above each new lower high. This locks in profits while allowing the trade enough room to continue. Sometimes these trades extend much farther than expected, producing exceptional risk-to-reward ratios. The objective isn't to predict how far price will go. It's simply to stay in the trade for as long as the market continues proving you right. Now let's see everything on a real chart. Here we're looking at British pound against the Japanese yen on the 4 hours chart. Immediately we can see higher highs and higher lows, so our bias is bullish. The latest impulsive move leaves behind several large fair value gaps, showing strong buying momentum. We mark the candle that created those imbalances as our demand zone, and simply wait for price to return. At this point, there's nothing to predict. The market has already shown us where buyers were strongest. All we're doing now is waiting to see if they defend that area again. Eventually, price pulls back into that area. Instead of buying immediately, we move down to the 15-minute chart. Here, the lower time frame is trending downward, but that's simply the pullback into higher time frame demand. This is something that confuses many traders. They see the lower time frame moving down and assume the market has turned bearish, but in reality, it's only correcting inside a much larger bullish trend. That's why the higher time frame always has priority. As price reaches the zone, we get a clear change of character and a fresh bullish fair value gap. Now higher time frame demand, structure shift, and momentum are all aligned. We enter near the beginning of the zone, place our stop below it, and target the next higher time frame supply. Here is the result. Now let's flip everything around. This time we're looking at US dollar against the Japanese yen on the 4-hour chart. Price is clearly making lower highs and lower lows, so we're only interested in selling. The latest bearish impulsive move leaves behind a bearish fair value gap. We are going to mark this candle that created the imbalance as our supply zone and patiently wait for price to retrace. Notice how we're following exactly the same process as before. The only difference is that this time we're trading with a bearish trend instead of a bullish one. The rules never change. Only the direction does. Once price reaches the zone, we move down to the 15-minute chart. Almost immediately, we see a change of character followed by multiple bearish fair value gap. That's multiple confirmations appearing at exactly the location we wanted. We can enter the first sell position as price retraced into the first bearish fair value gap. Price continued lower, but it reversed and hit our stop loss. Some traders may choose to add a second position with smaller risk at the second bearish fair value gap. Scaling into a position should only be considered after the market has already confirmed your original idea. Even then, every additional trade should carry less risk than the first, so you're protecting your account while taking advantage of continued momentum. Remember, not every trade wins. Even professional traders take losses. What matters is having a strategy with an edge and executing it consistently over hundreds of trades. Avoid chasing unrealistic returns or jumping from one strategy to another every time you lose. Consistency, discipline, and proper risk management are what produce long-term results. If you found this video valuable, don't forget to like the video, and I'll see you in the next one.